This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're going to be talking about provisions, contingent liabilities and contingent assets. You have met these topics before in financial reporting. The knowledge is very straightforward, but it is important, again, that you can write about them accurately. Remember, first of all, that provisions are liabilities. So we don't say provision for depreciation. It's not right. You don't say provision for bad debts. It's not right. You're supposed to say allowance if you're adjusting asset values, but provisions are liabilities. And you'll remember that the definition of a provision is a liability of uncertain timing or amount. So it's the regular rules with liability accounting. It's just that you're not quite as sure about when the amount will be payable or what the amount is. Typically, of course, in something like a big legal claim that's being made against you. The standard was introduced because companies would abuse the rules on provision accounting. So in a year of high profitability, they might set up unnecessary provisions to bring the profits down and then release the provisions in later years when they wanted the profits to be a bit higher. That's sometimes known as big bath accounting. Bath, that great big thing we sit in to wash ourselves. So first thing is, in what circumstances do we recognise a provision? Well, there must be an obligation as a result of past event. It must be probable that we will have to pay money, and ultimately we can see what the amount of money is going to be, more or less. That obligation could be legal, for example, a contractual obligation, or it could be constructive. Remember that a constructive obligation is where you have a practice of doing something. If I have a practice of cleaning up environmental damage, that's a constructive obligation. I've always done it in the past, so the assumption is I'll do it in the future. Should we recognise a provision, it must be recognised at our best estimate. Sometimes with something like a provision for warranty claims, then you can use expected values. So there's a 30% chance of X parts being returned and it would cost this much to repair them and so on. If the amount paid is way into the future, more than a year, then you'd also need to discount back to present value. The examiner would give you the discount rate. That's it really in terms of the basics of provisions. In a sense, for me, the most important word is to say, I recognise these things only if they are probable. Recognise, remember, means include in the double entry system. So let me just say, recognise if probable. You might want to pause the recording, read example 1, have a think about it, and then have a look at the solution before you continue the recording. So when you looked at example 1, you noticed that there was a publicised environmental policy. That's what gives you the constructive obligation, and therefore, because of that, they will recognise provisions for all three lots of environmental damage. So there is a constructive obligation. In the standard, they talk about various potential provisions. You can't make provisions for losses, end of story. You can for onerous contracts. This is where you sign up to a loss-making contract. You might say that's a bit silly. It happens because someone in the sales department is so anxious to get their sales commission, they don't think about the related costs, and the accountant will be very cross, but they'll have to recognise a provision for the losses on that contract, where the costs would exceed the revenue or the benefits. The most common provision that you would see probably in the exam, like life, is restructuring. Restructuring is unfortunately another word usually for redundancy, isn't it? So if actually some of the staff are to be let go, should you recognise a provision? Very important words. These words again highlight constructive obligation. Well, you recognise a provision if there is a plan and the plan has been announced. If the staff are aware that they're going to be let go, clearly the company cannot go down. It's stuck with, again, it's stuck with the obligation. It will have to pay them off. We recognise a provision. Finally, environmental provisions, which are sometimes associated with fixed or non-current assets. If you build a wind farm, the wind farm would be PPE. As it says in my example, it costs 40 to build, and perhaps the law says it takes 8 to take down at the end of its life, present value. So the total cost of construction is 48. 40 to build it, 8 to knock it down, total project costs 48. So where's the double entry there? The PPE is capitalised at 48. We pay cash today of 40 and set up a provision for 8. The 8 will be at present value. So over the next few years, the discount will unwind and that 8 will grow in value. Again, that'll give you the discount rate in the exam. There's the double entry. So 48 million in PPE, that's the amount that will be depreciated. Now, there is often confusion about words like provisions and contingencies. So with contingencies, I would probably focus on 2 facts. The first one, in fact, I'm going to look at the second part of this diagram first, is contingent liability. A contingent liability is a possible obligation, and it must be disclosed in the notes to the accounts. I'm going to put FS for financial statements. So, if a liability is probable, I will recognise it. If a liability is possible, I will disclose it and I will give it a name. My name is Steve. We do not call it Steve, we call it contingent liability. It's just a name. On the asset side, remember please, the important thing about contingent assets is that they will be disclosed if they're probable. Probable is more than 50%, like tossing a coin. So we might just try and summarise what we've said so far. And I'm just going to draw a little diagram down here to summarise what we're saying. Don't forget, you can pause the recording. I'll put a column for liability and a column for asset. I'm going to think about 4 degrees of certainty. Almost certain, or virtually certain. Probable. Possible. And remote. Remember that liabilities must be recognised if they are virtually certain or probable. We will disclose the contingent liability if they're merely possible. So I've put CL in brackets, meaning contingent liability. If a liability is remote, we ignore it. Life is too short. For assets, we only recognise them if they're virtually certain. A probable asset is disclosed. And of course that's a CA, which means contingent asset. Let me just put CL here and CA there. Anything else on the asset side is ignored. They're very basic rules, but very important, and important that we don't get them into a mess. Can you think of anywhere in the syllabus where these rules are ignored and all liabilities, for example, are measured at fair value? What's the area of the syllabus? Have a think for a second. It's group accounts. So when you work out goodwill in your group accounts, everything, for example, all liabilities, must be measured at fair value, irrespective of their probability. You might like to have a look back at that in the earlier chapter. There we are. That's provisions which are recognised and contingent asset and liabilities which are disclosed. Thank you.